Did your Uncle Tony tell you last year that real estate couldn't fail? Well, I'm sure for 2022 you did realize he was probably incorrect. In this next video, we want to discuss some of the challenges that our investors are facing.
In this video, we're going to discuss flippers and some challenges that they're facing in the market at the moment. People who are dealing with high utilization, whether that's high limits on credit cards or lines of credit, as well as investors who are dealing with multifamily financing and some of the challenges they're facing on repositioning the products. Hey guys, Josh Ehren from the Findlay Mortgage team. In today's video, we want to talk about some challenges in the real estate market and some solutions that we are able to provide to help you transition through this tough time.
Yeah, we've seen a lot of market changes over the last year. A lot of people getting stuck in some of their flips, not having as aggressive takeouts on their BRRRRs. Multifamily pricing still staying high, rates still staying high, having some challenges on the takeout financing, lots of high credit utilizations. So we want to take a look into some of these, how they're presenting challenges for some of the investors and some of the solutions that we have to help.
Yeah, I think the main issue here is just Plan B is actually coming to fruition. You know, everybody who was in a project last year, nobody projected rates to double. So the challenge right now is, how do I get my money out? How do I move my money? How do I transition into looking at an option that wasn't necessarily my first option? Because most people who are in a flip, you know, they had this grandiose idea they were going to sell and make a ton of profit. Unfortunately, as everybody knows, the market cave out. We're seeing 20 to 30% drops in value over the last 6 months. And if you were in a flip and you bought it probably in December, January, February, you're probably underwater on those deals. And we're starting to see, some clients come to us looking for some alternative solutions that maybe allow them to hold it and hold it for a little bit longer than they would have liked to allow them to cash flow and maybe wait until the market comes back.
Yeah, flipping is one of these things where you may not feel like you need a mortgage professional working with you because you're not, the goal is to sell it. You're not looking at anything sort of qualifiable. You can get it done with a private lender. You don't need to follow these standard stress tests. But as we just saw, one of the greatest things you could have done at that time was stress test your exit just in case you weren't able to sell. And that's something that I think everyone should take into consideration moving forwards. It's great if you're looking to sell, but Plan B is going to be holding on to that property. If you can't sell that property and you're just moving from one private lender into another, what does that do to your carrying costs and your holding costs, and what does that do to your bottom line, and how much in the red are you going to be after that?
Yeah, I think it's also interesting to think about, how do you structure something like this? Because for those flippers who had 2 or 3 projects on the go, if your plan B now is to try to restructure your mortgage, but you have high interest private loans on your entire portfolio that you're holding at the time, how do you transition into something more conventional when you don't have either the income or the ability to service all that debt conventionally anymore? So we're starting to see some of these challenges that we haven't had to deal with in the market come up, and it's interesting to kind of go through the different steps to help investors try to get out of the situation.
Yeah, and something else that I've seen too is as flipping was gaining popularity and becoming more and more frequent amongst investors, their accountant advice was to do this in an active company, just to kind of help offset some of the taxes. But when you come to the mortgage financing side, if your company comes off as an operating company, it's going to create a lot of challenges for lenders wanting to move forward. Lenders are happy to lend in a holding company, but there's not a lot of lenders that actually want to lend in an operating company. So I've seen a couple of clients that got stuck holding onto properties in an operating, and it does limit who we can go to do that refinance in that situation.
Yeah, definitely does see a different perspective when you're looking at exiting on the sale and then having to hold it longer term. So let's talk about some of the solutions in the market that we're seeing at the moment. So one of them being, if you are stuck in a flip, let's say you have one, you can't sell it for what you're looking to sell it for, you have a bunch of capital into the project, you don't want to take a loss on the actual property. What can you do? A lot of the time, if you qualify with conventional financing, obviously the name of the game is just to refinance the property at 80% of the current value, leave some of your invested capital in the project, and wait until the market kind of turns up, whether it's a year, whether it's 2 years, however long that's going to take. Wait for that until you can either sell it or refinance and pull your capital out. Now, if plan A doesn't work and you don't have the income to be able to support the debt, what do you do? Well, there's alternative options right now in the market that are allowing for increased amortizations, 35-year, 40-year AMs, large rental offsets on your portfolio. There are some additional options that allow you to be able to take advantage of how your current operations are. So if you do need to take on conventional debt at that higher interest on an alternative loan, the pushed out amortizations are going to reduce the carrying costs. And you might be losing $200 a month, $300 a month, but at $2,000 a year or $3,000 a year of loss, a lot of our investors are coming to us and saying this makes sense compared to taking a $50,000 wash in the entire project.
Yeah, I agree, and I think that kind of leads into our next part of flippers and burrs. A lot of these investors were taking on lines of credits and credit card debt, maybe even borrowing prom note or other private debt to be able to get these projects done. Leverage was really all the rage in 2020 and 2021, and was talking about that. Now when you're stuck in these projects and these burrs that you're only getting 40% efficiency, maybe 50% efficiency, that means you're leaving all this debt on your your trade lines. And when you come out to some sort of emergency refinance on the back end, having these higher debts and not being able to pay it all down, it's going to affect your ability to qualify, but it's also going to affect your ability to get into your next deal. If you take a look at your next deal, either for investors that were using their lines of credits to help with down payment or renovation costs, or if we're just looking at your ability to personally debt service your next purchase, or again, if you have other flips in the pipeline that you're not able to exit out into, and now you're stuck looking at refinancing maybe not one but like 3 or 4 properties, having that high debt utilization is just going to impact you moving down the line. And by the time you get to your second or third property, maybe you're looking at refinancing, like we said, out of a private just into another private, just to help offset or get you out of that term that's expiring, and just giving you more time to either try to sell the property or wait for rates to come back down and sell at a bit better of a profit.
It's definitely a tale of the tape at the moment. We're seeing people who are in that emergency situation right now who are looking to refinance. And maybe your credit score has dropped to like 600. Conventional financing no longer is available for you. Even if you do have the ratios to qualify, if your credit score is 600 or below, that's a serious issue. And the issue with it is they're usually time-sensitive situations. So, for example, I had a client who had like a 560 credit score because their utilization is maxed on all their lines because they're in a situation where they need to get out of this flip, so we're refinancing it. But you have to refinance it to be able to get the money out to pay the utilization down. So it's a cart for the horse situation. Within 20 days of sending my application into a B lender, their credit score had dropped to 520. And now no B lender is going to actually do this deal. So now you're in a situation where you're transitioning into private debt to pay off these lines to increase the overall credit score, which, it's a cyclical thing. So if you find yourself in a situation where you're absolutely maxing your credit lines, like, the name of the game is time at the moment. You need to be able to move quickly and efficiently to be able to make sure that your credit score doesn't drop below a certain level, so that you can actually attain some sort of conventional financing.
Yeah, and just paying your minimum payments, for those individuals that are stuck in that situation, doesn't actually help your situation when we're taking a look at credit. If you're sitting at anything above 50% of your utilization, I see it quite often. Investors taking advantage of these zero interest cards. They max them out 80, 100, 60, 80, $100,000 and let them sit there, and they're just making their minimum payments. But I've seen the same thing where borrowers start at high 600-700s, and by the time they get to a transaction, they've had $100,000 sitting on a credit card making the minimum payments for 8 months, and now their credit score is in the 530. I had a commercial deal last year where that was the situation. We got right to the finish line. Credit team went to go do their checks and saw what his credit was, and that killed the whole deal right there. So not being able to pay these down, or just thinking that you can make the minimum payments and get by and not have your credit impacted, it's not the right train of thought. You got to at least get that back down under 50%.
Agreed. And like, waiting for my refinance isn't always the best option, because if you're maxing out and waiting for the refinance, you're essentially rolling dice on your utilization. Obviously, if you have high utilization on multiple lines, it's going to affect you more, but just be aware of it. Like, if you have a credit reporting software that you use, whether it's Equifax or TransUnion, keep an eye on it, like, especially when you're in the middle of a project, because that could be the difference between conventional financing and then private debt. And obviously the cost of being able to do either of those drastically changes depending on the project.
And I think that leads us into the next topic we want to touch on was some of the challenges that multifamily investors were experiencing. If you take a look at the rates that we were using in January of 2022, we were underwriting at mid 3s, 3.65. Fast forward to now November, we're underwriting at 6.8%. You're almost seeing a double in the rates. That creates a lot of problems for the investors who got into projects late last year, start of this year, that were running numbers maybe conservatively at a 4%. We're still 2.8% above that right now. So we're seeing a lot of investors either have to pay down the difference out of pocket. So for example, if you have $1 million loan and maybe now that the rates are up, you can only afford $900,000 on your refinance. That $100,000 difference has to be paid out somewhere. We're seeing some investors just pay that out of their pocket. Some investors are tapping into maybe equity in other projects that they have, putting on small second mortgage to be able to pay that off. Or we're seeing some investors just refinance from slightly higher expensive private debt into slightly more affordable C or private money, again, just to be able to help out on their bottom line, keep some of that cash flow going back in their pocket. So it's a challenging time right now for multifamily investors.
Completely agree. The issue with multifamily, in regards to like a project perspective, is that the duration of completing one of these projects takes a significant amount of time, from acquisition, renovation, stabilization, refinance, and then if you're going to refinance into true conventional debt, so CMHC, that process could take a year to 2 years to complete. And when you're in a variable market like this, where interest rates are rising so fast, it's hard to be able to project out what that's going to look like. And nobody really saw or expected that rates were going to double the way that they did. So as you said, a lot of investors are looking for some alternative solutions here to be able to maybe recoup some capital, or to transition into more conventional, like lower carrying cost debt to reduce their overall carrying costs, or to increase cash flow in these projects for a shorter period of time. Last year we saw people who were looking at, this is my forever hold. I'm going to transition into this. I'm going to hold it because it's a great rate. Now it's more like, well, what short-term solution is there in the market right now for me to be able to maybe hold on for 2 years? Maybe take some of my capital out. I'm okay with leaving some of it in. And then in 2 years from now, let's revisit it when hopefully fixed rates are back down to a more normalized level, where we can refinance and restructure our debt into something that's more of a long-term solution. And I think that those short-term options right now are becoming increasingly more popular, because usually the multifamily investors have multiple projects on the go, and maybe that cash flow or that like cash outlay was a little maybe overextended at the time. So we're starting to see a huge transition into more, as you said, C debt, where you have lower debt servicing ratios, increased amortizations, more flexible terms to allow for that transition in maybe 2 years from now into a longer term solution.
Yeah, and some of those transitions from acquisition financing to your takeout financing, if we're taking a look at a pathway that leads to CMHC, with the prices of multifamily that we saw at the start of the year heading into 2022, prices were definitely up. People are starting to price in the fact that there was vacancies, or they had this high ability to turn over and get this value. So these prices, there were a lot of individuals that had to go with just straight hard money, and that's not always the easiest path to go into CMHC with. It's a bit of a gray area really, and everything that I talk to with our CMHC underwriters, it really just depends on who picks up the file and who feels like getting it done and who doesn't. If you're working with a private lender that's not specifically set up and designated to go directly into CMHC, there is a chance that you're not able to go directly into CMHC, which means you have another 2 month period in there where you have to do just some sort of bridge conventional takeout financing to be able to pay out that private lender or pay out any of your investors, and then jump back into CMHC, which can be anywhere from 3 to 5 months depending on the project. So again, you're extending your timeline, keeping yourself in slightly higher interest debt. Those bridge loans are they're higher interest, but they are interest only, but it is somewhat similar where you're going to be on a private loan, and then by the time you get taken under CMHC, it's a long time period.
Yeah, no, I completely agree. I think it's also interesting to see that it's the only asset class that's truly holding up in value at the moment. And we're going to shoot another video, and you guys are going to see it after this one, and we're going to talk about obviously multifamily investing and why it's the best asset class currently for this market. But the challenges in this market are real. The solutions in this market are also real. If you guys are dealing with any sort of these challenges with any of your projects, whether it's a flip project, a BRRRR project, a multifamily project, understand that other investors are dealing with this right now, and there are solutions solutions in the market. Now, maybe not a long-term solution, but a short-term solution to help with either your cash flow situation or acquiring some of your capital back to either take advantage of the market moving forward or just to stabilize out your current portfolio at the moment. It is a dicey time. There are a lot of questions being asked. If you guys have any questions at all, reach out to Ehren or myself, or a mortgage professional who truly understands what they're doing, because that single bank with that single product might not be the best option for you, especially in a market where you're looking for a solution. Having somebody who understands different types of capital and different products and solutions that this capital is going to allow you to do is imperative to kind of succeeding in this market.
Yeah, and especially with the majority of wealth being made in a down market, the last thing you want to do is make an emergency short-term decision that impacts you, and your ability to be able to buy, next year and the next coming years, while we're in this lower market. So like Josh said, reach out, let's take a look at your portfolio, put together some options, and make sure you're moving forwards in the appropriate direction.
Yeah, if you guys found value in this video, we really appreciate it if you hit the like button, hit the subscribe button. It allows us to create more content just like this for you guys. So again, if you like this video today, hit that like button. We really appreciate your time. We'll talk to you soon.